Well, good evening, everybody, and welcome to the August 2025 version of the Investing Roundtable. We have two special nights with us this evening. Matt Spielman from the Houston chapter will be presenting, and so will my good buddy Mark Robertson from about 40 miles south of me in Rochester Hills, Michigan. I'm coming to you direct from my dining room in Genesee, Michigan, and the Mid-Michigan chapter is very pleased to co-sponsor these roundtables as we've been doing for the last 16 years. We're co-sponsoring them with Manifest Investing, and that's a tool that all of you should be familiar with, and I would encourage all of you to make it a part of your stock studies as we move forward in what we're doing here.
Ken,
let's get this whole thing underway. Go on, Mark.
ask me why I'm here tonight.
Why are you here tonight, Mark?
Because I didn't win the Powerball.
Oh, okay. We did have a Powerball, supposed Powerball winner in Grand Blanc, Michigan, which is about 10 miles south of me here. But Mark made the comments at the bull session that the Powerball announcement of that big winning was not true. So did you find out that it was true, Mark?
I haven't got any 100% verification, but they're still claiming an $800 or $900 million prize for Wednesday. So I suspect that there was not a winner.
I will tell you that it was not on any of the local news, and usually that's all over the local news when it happens. So
yeah, it wasn't on Powerball's website either. So they know, right? They don't know who you are, but they know where all the tickets are purchased, and it did not show up during bull sessions. I checked.
Dennis is asking me, what tool was I just talking about? Dennis, I'm talking about Manifest Investing. That's Mark Robertson's tool that we show dashboards on in these shows all the time. We'll be demonstrating things that Manifest can help us do this evening even. So we'll stay tuned, and you'll see us using that tool in real time. Let's move on to the disclaimer. Basically, there is no, we're using this roundtable for educational purposes only. We're not making any recommendations to buy, sell, and hold. And that's all you really need to know. If you'd like copies of the slides themselves, drop an email to Mark R at manifestinvesting.com. And he and I both like to answer questions about the roundtable. We've been doing it for almost 16 years now, and those are our two email addresses at the bottom. If you'd like to get a reminder of the roundtable, you can look at the Mid-Michigan section of the Better Investing webpage, or if you get the slides, you can hit subscribe, and that'll take you directly to a URL that will help you subscribe. Mark's pointing to the URL that will take you directly to where you can subscribe. When you get to this page, you will have to scroll down a little bit to find the form, and the form takes you about 15 seconds to fill out. And that way you'll get an email from the Mid-Michigan chapter once a month reminding you of the roundtable and offering you a link to registration then. So let's go to the next slide, Mark. And here's our performance. It's been awfully difficult in the last year or so to keep up with this market that's running somewhere in north of 20% right now. But we finally have an upswing in our relative return. We had dropped down to under 2%, and now we're back up to about 2.5%, and we're moving back towards that orange line, which represents the very aggressive goal of beating the market by 5 points. For a while there, we got a little complacent. We were able to do that for a 5 or 6 year period most of the time. And we're confident that we'll be able to move up towards that orange line as we continue nice and steady with good, solid investments. Our rate of return since inception is actually higher than that 15% goal. It's just that the market has been doing a lot better than average over that time. We've been returning 16.4, and over the same time period with the same ins and outs money-wise, The Wilshire 5000 has been returning almost 13.9%. You take the one number, 16.4, minus the other, 13.9, and you get that relative return, 2.5. Another way to say relative return is to say, how many points did you beat the market or did you lose to the market? And we're beating the market by 2.5% at the moment. For a 16-year portfolio, that's an extraordinary return, folks. We're very, very proud of what happens, and we find ourselves in very rarefied atmosphere. There's probably no more than 50 or 60 mutual funds that return this kind of return over this long a period. So we've also set ourselves a goal of 55% accuracy. We've done a lot of studying, read a lot of literature that indicates that a 55% success rate is usually enough to have outstanding returns, and our outperformance accuracy that for many years languished in the mid to high 40s has now moved up to 54.4%. That's about as close to our goal as we've been that I can remember. Mark, can you remember when we've been closer?
That's the highest in a very long time, and we're seeing some really good tailwinds for smaller companies right now.
Excellent, excellent. So we're very positive and feeling really good about the portfolio right now. And let's talk just a little bit about the portfolio before we get into our stock presentations. Here's our top 20 holdings in the portfolio. You can read that legend up in the top there, all of that black stuff with all the stock tickers on it. Go down 3 lines, for example, where it says 4X. Everything that goes after that 4X, all of those companies, starting with AMD and then Bristol Myers and Corpay and Dow, etc., all of those companies have been chosen 4 times over the period that we've been in operation. Our highest choices have been at Cognizant Technology at 15 times. And if you don't see a stock anywhere in the column right here, but you see it when you access the portfolio itself, and you can look at the entire portfolio with that URL at the upper left-hand corner there that starts out with www.manifestinvesting. That'll be the entire roundtable portfolio, and there are some stocks we've only chosen once. They're not listed in the legend, so if you don't see a stock listed, it still might be in the portfolio with only one choice added to it. We're talking about, well, Costco, for example, is a great example of a stock that's only been chosen once in the entire 16 years, and yet it makes the top 20. So Costco is a real performer, but most of you in the community understand how good a stock that does happen to be. You can look down and throughout the entire list of the top 20 there. My general rule of thumb is if you don't own 4 or 5 of those on that top 20 list, then your portfolio is probably not doing as well as you'd like it to be doing. This is some of the best stocks in the entire world on this top 20. It does not include all of the Magnificent 7, but it does have a great representation in the Magnificent 7 right now, including Microsoft, NVIDIA, Alphabet, and Amazon in the top 6 or 7 right there. So I think I've beaten that pretty much to death, Mark. Let's go on to the next slide, okay? We're going to talk just a little bit before we start our stock presentations about foundational selling. We think that the tracking portfolio has gotten to the point where it needs a little bit of tinkering, a little bit of work, and we're going to be doing some selling, and we're going to try to set some standards and then set some rules for exceptions to those standards to tell you why we don't think they should be sold. We went through the entire roundtable portfolio and we listed every single thing that had a return forecast at 5% or less. Now, I don't want you to get the idea that this is a list of the worst stocks. This is just a list of the stocks that at the present time have a forward potential of 5% or less. I will tell you that there's some really good companies on this list, and there are some clinkers on this list as well, because a list like this not only would include stocks that are doing really well in the market, but it also will include stocks that have the wheels have come off and the business model is in question. Notice the low quality rankings for the stocks with the worst return forecast, the ones that are negative, and notice some of the high quality rankings for the rest of the list. These are stocks that have just taken off, done really well, and gotten ahead of themselves price-wise. When that happens, when they're a little bit overbought or a lot overbought, then the par sinks to numbers that you're looking at right now. We were talking before the roundtable began that on this list, we definitely would be saving Interactive Brokers and Fabrinet with quality rankings of 95 and 100 and growth rates, sales growth rates of 15 and 13. There's no reason at all to remove them from the portfolio. And outside of the roundtable, we'll be making some decisions about the rest of the companies on this list and then telling you what we're going to freeze the position in. We know that sometimes we make real mistakes, and we're kind of thinking that maybe Mark has circled 5 of those mistakes up at the top of the list up there. Luminar, Service First Bank, and First Foundation. Service First Bank is a little bit different than the other 4 positions. It has a little bit higher quality rating, but it's still not a company that we would suggest is in the same category as those with the quality ratings above 80. Go on, Mark.
Probably done pretty well, though. That's why we're going to add that relative return column here so that I can make the point that Service First has done very well. And yeah,
we actually own Service First Bank shares in the Wolves Investment Club, and it's done quite well for us. We have a really nice capital gain in Service First. So we are looking at it, though. We're challenging it with a couple of other banks just to see if it's still what we want to hold. There are some banks that maybe are even in a better category than Service First.
I also think we should make it clear that we're going to come up with a process, and we'll figure out a way to do this, right in the sunlight. Everybody can watch, but we do want to, we want to subject the companies that are on the true hot seat. These are hot seat companies at the top of the list. Put them on the hot seat, audit them, and have a legitimate discussion. Here's Ken's second category. He just wants to highlight companies that are worthy of hot seat moments.
Yeah, these are really low quality companies. When we put this list together, I just asked for companies that had low qualities that weren't already on the first list. So we're looking at quality less than 30. And again, there's not all bad companies on here, but there are some clinkers, and I'll claim Fox Factory. I presented it twice in 2022, and its quality has just degraded to the 26. I can assure you that hardly ever have we picked a company that started out with a low quality rating. Mark is putting a line through Portillo's, one of his most favorite hot dog companies.
It's off limits.
I don't know if he's taking it out of the portfolio or telling us we can't discuss it. I don't know which it is.
I'm encouraging ostrich behavior here. Just stick your head in the sand and.
We will use the same principles for keeping or rejecting a portfolio for Portillo's as we do for all the rest of them. So I'm identifying Fox Factory as ones that probably needs to leave pretty quick. And then here's our last category. We've been able to really come up with some ideas about how fast a portfolio has to grow as far as its sales growth in order to hit that goal of beating the market by 5 points. And we're convinced that if you can't boost sales growth up into the 12, 13, 14% range for the entire portfolio, then you're not going to be able to hit that goal of beating the market by 5 points. So right now, our sales growth is around 11, and that's a little bit anemic. So we're looking to boost that, and one way, of course, to boost it is to eject some of the companies with slower sales growth, especially if they represent a large part of the portfolio. Some of these holdings are infinitesimal when it comes to what they represent in the portfolio, but MKS Instruments, for example, is actually in the top 20. So moving it out of the portfolio probably will give a real boost to our growth just by pulling this less than 4% grower out of there. Again, not all the companies on this list are terrible, but their sales growth has slowed considerably from where the sales growth was when they first were introduced to the roundtable. You'll notice in the purchase date column that there's very few very current picks in this particular list. So they've had 2 or 3 or more years to have their sales move into a place that we regard probably as too slow to continue to be included. And we'll look at these again as individual companies, and we will make exceptions with real reasons behind them. But if we can't come up with a real good reason to hold it, then we'll probably move it out of the portfolio as well. We'll keep you apprised of what we're doing with this. We'll try to show you and explain to you what we're doing in the portfolio as we move forward. But we'll be doing a lot of the hard work at our 2 p.m. bull sessions that occur every Tuesday. And if you want to be part of that conversation, then we would encourage you to take some time and occasionally come to one of the bull sessions. We won't be doing it every single bull session, but I would imagine you'd see us every second or every third bull session doing a little bit of work on managing the roundtable portfolio. That's enough on that topic, I think, Mark. So are we ready to get started, or do we have something else to talk about yet? Oh, you have the round table itself. That's a wonderful picture. Did you generate that with AI, or did you find it on the web?
I think I just found that one. Yeah, that's not AI at this point.
Okay. So looks like I'm first in the batting order right here with Tecnoglass. I first presented Tecnoglass about 2 years ago, and I presented it twice within a relatively short period of time. And this company had a little bit of a backup after I presented it. But then it's really taken off again, and it's really going to town, and it has a lot of potential going forward. So I'd like to explain to you what Tecnoglass is and what it does, and then show you an SSG for Tecnoglass. It's stabled. Its main offices are in Miami, Florida. It's a complete American company, but it does a lot of its manufacturing in Colombia. And before somebody mentions the dreaded word tariffs, I will reassure you of the fact that the United States actually has a balance of payments that's positive with Colombia, which means we export more to Colombia than we import from Colombia. They still will pay taxes on whatever we bring in from Colombia, but they'll be of a relatively minor amount. There also will be a little bit of aluminum tariff attached to some of the aluminum that's part of the windows that are being imported from Colombia. I'll talk more about the Colombia manufacturing and why it's such a benefit to this company, but this is a medium-sized company that is just operating on all cylinders. You'll notice that it only amounts to about 5% of the addressable market, but it is one of the largest, if not the largest, glass company in the U.S. market, even though it only occupies 5% of the total addressable revenues for the United States. The end market, you'll notice that Tecnoglass is roughly evenly split between residential glass applications and commercial glass applications. They do both. If it's glass, then Tecnoglass does something along with that. And they've recently moved into vinyl windows, which have added a lot of growth to the residential portion of what Tecnoglass does. Here's some of the brand names in the bottom corner that you can see right there. And that's just some of the brand names of the glass that they sell throughout the United States. And most of the glass, over 95% of their sales, are within the United States. The next slide shows that they have a real heavy penetration in Florida, doing a lot of sales to both residential customers and commercial customers, especially in hurricane kind of glass. Florida is known for being buffeted from both coasts with hurricanes, and Tecnoglass provides a lot of glass that is required now in rebuilding in a lot of places in the state of Florida. They also have penetrated really heavily into the state of Texas and are moving, that's their second highest sales place, the state of Texas, and they feel that they've gotten a good foothold and are moving, especially with residential glass in the state of Texas. And then you see that they, the light blue colored states, those are the states where they're just beginning to do business, and they are working very heavily on both coasts. The red dots are some places where they have showrooms. The blue dot is a place where they do a little bit of assembly and manufacture. That's in California. And you can see there's a lot of the country that they haven't even begun to penetrate now. For example, in my state in Michigan, there is nobody selling any Tecnoglass products at this particular time. Again, you can call for the slides and you can read this entire slide over on the left-hand side. If you're interested in Tecnoglass, I would urge you to look at the investor presentation. It's a brand new August 2025 presentation, and it's on their website. It's easy to find, and I would urge you to take a serious look at that. It gives you a lot of things that they do, and it tells you what they expect to do into the future. Next slide, Mark, if you would. Here's pictures of some of the kinds of glass that they deal with. Again, about 50-50 between commercial types of glass and between single family kind of applications for glass. I've blown up this little piece of the slide about glass technology, and if you'll give me one more slide, we can take a look at the different kinds of glass that they have. Everything from low emissions, which means that the glass will filter out of a lot of ultraviolet rays and bounce them back to the outside while it's allowing sunlight to come through. Tempered glass, insulated glass, laminated glass, printed glass, silk screened glass, blast resistant, hurricane resistant, thermally broken glass. And again, if you need definitions on what's happening there, you'll get a great read through for each of their kind of applications on their website. You can also see in the horizontal window on your right there that the residential part of their business, which was virtually nothing about 10 years ago, is now reached about 45% of the business, and that percentage keeps creeping up. The residential portion is represented by the blue part of the bar. The gray part of the bar is their commercial business, and they started out with a purely commercial mix of glasses, and now they've moved big time into residential glass. They are a fully integrated company which means that they control the supplies, the raw materials, they control the production process in a huge, huge plant in Colombia. They therefore control the final product, and they even control sales, distribution, and installation of their products. Completely vertically integrated, which means they have their hand at all places in this chain of events that takes you from some sand to finished glass. Next slide. They have a huge backlog, over $1 billion backlog, and I've captured this paragraph from their website that explains that about 63% of any backlog in any given fiscal year rolls out of the backlog, which means they've completed whatever the contract is within 12 months, and about 97% of the backlog, in other words, all of it or mostly all of it, rolls off of the backlog list within 18 months. So this is not backlog that just sits there and continues to grow. This is backlog that they're actually rolling off, and it's fully contracted business. Because they're doing business at the end of most building processes. Glass is one of the final things to go into a lot of the places that use glass. They have a very low cancellation rate, and that's very interesting, which means that anything that they've contracted for and is included in the backlog, almost all of it is actually realized in the end product. There's no cancellation in between when the contract is signed and when they're going to be delivering and installing the product. Let's go one more slide, Mark, if you would. Here's our lines. The company got a little bit ahead of itself right after the pandemic. You can kind of look at the earnings line from 2020 to 2022. They got a little bit ahead of themselves. Because they were doing commercial business, they were able to continue working a lot of what they do during the pandemic because they could socially distance. They weren't coming in contact with the general population. And that was also true in a lot of building of residential buildings, single family and multifamily homes. They were able to continue work. So they were able to keep working and got a little bit ahead of themselves, like I indicated. 22 to 24 was not nearly as hyper growth in the earnings. They kind of slowed in their sales growth, and the earnings backed up just a little bit because they actually worked a lot of their backlog off. But about the middle of the fiscal year 23, the quarters started to increase again, and they've now increased for 4 consecutive quarters. 2 of them you can see right on the graph of continuing movement upwards again. And they're back basically with parallel to their sales growth. Their earnings are matching their sales growth again, as it had done for most of the period that we're looking at here on the graph. Next slide. I've chosen growth of 12% of forecasted growth. That's certainly within the range of where value line happens to be. That's a value line capture where it says annual rates, and I've circled what value line thinks the rates might be for revenue and earnings 3 to 5 years from now. I've also circled what Manifest Investing has suggested the sales growth might be. Manifest has 11.1. I've settled on 12% sales growth, 12% earnings growth, and that certainly matches these 2 sources and also matches another 3 or 4 sources that I haven't put onto the slides. You can see that the pre-tax profit has been really since 2021 has been fairly consistent, somewhere around 20 or above. You can see, again, it got a little bit ahead of itself right after the end of the pandemic. It's backed off a little bit, but that's still an excellent pre-tax profit, and it's higher than the 5-year average. Return on equity numbers, same general pattern. In 2021, they took off and they haven't looked back. Those numbers above 20% are really superb, and they're doing it with declining debt. That debt especially is intriguing to me, going from 51% at the beginning of the pandemic down to 15% in 2024. So the debt is really moving in the right direction to keep things on the fiscally safe side for this particular company. Next slide, please. My study projects earnings at that 12% rate at about 686 5 years from now. Manifest projects 730. That's certainly a number very close to mine. And Value Line in their 3 to 5 year projection projects 715. Again, very close to the number I've chosen for my earnings in the next 5 years. I'm modeling a high average PE of 24 and a low average PE of 12. If you add the 24 and the 12, that gives you 36, and half of that would be my average forward PE of about 18. Manifest is suggesting a 20 as a logical number. A Value Line is suggesting 17 as a logical number. And again, I feel I'm right in the mix of my two trusted sources when I'm using 18. One more click if you would, Mark. Using that 12% earnings growth, I'm getting a par value of 16. It's certainly in the same ballpark as Value Line, which is telling me 4 to 15%. That 15 and 16 are pretty close. I'm sorry, I'm misspeaking. I'm getting a par value of 12, which is certainly in that neighborhood of 4 to 15 that Value has, and it's a little bit lighter than Manifest suggests at 16. I'm getting a buy. I'm getting a high enough growth to double my money in 5 years, although that's not a requirement for any stock in your portfolio. It's your portfolio you'd like to see grow at 15 plus, not individual stocks, although you need some growing faster if you're going to have some growing more slowly. One more slide, if you would, Mark. I've made the case that we should be adding $1,000 Tecnoglass to the portfolio, and I would urge your consideration when you come to a vote. I first presented Tecnoglass in August 2023 at $33.86 a share. In January 2024, I presented it again at $46.30 a share. And right now, the current price as of yesterday was $72.82 a share. Notice that's more than a double in price since my first presentation just exactly 2 years ago. So that's all I have to say about Tecnoglass. This picture at the bottom just fascinates me. That is not a distortion in the upper right-hand corner. They have a glass called Tecnobend, and they can bend it in 2 directions at once. So they can twist it in 2 different directions and then put it into structures. And that's an actual structure built with Tecnobend glass. It's not been distorted in any way, shape, or form. That's a straight photograph of the structure. And they're demonstrating in that diagram at the bottom on the left how they can make perfect cylinders out of this Tecnobend glass. And that's something that in large cylinders has been almost impossible to do. We can, of course, make glass tubing in small diameters, but when you get to large diameter, this has been something that could not happen in the near past. And now they can make these cylinders, which have all kinds of industrial applications. On the right, we're just drawing to your attention that a lot of the glass is low E series, and that's used in a lot of the skyscrapers that have glass windows. And basically that keeps the building much cooler because it filters out a lot of the UV rays, and they bounce back into the atmosphere instead of going through the glass into the building. So that's the end of my presentation. Thanks for listening.
Okay. Keep in mind that this was one of our best small companies for a couple years, going back in that time frame.
Do we want to take a question for that? We have one.
Yeah, I'm going to
Sure.
answer Dennis's question, okay? And I think I answered it during the presentation. Dennis wants to know why Tecnoglass corrected so very much earlier in August. And Dennis, they corrected after they got ahead of themselves during the pandemic, when I suggested they were able to continue working, and they worked off a lot of their forward business. They were able to keep it going. They weren't booking a lot of forward business during the pandemic, but they were working off a lot of contracts that they had already signed. They did not shut down from work because of the nature of their work. Their crews were able to work outdoors, and whether it be single family construction or whether it be skyscrapers, they were able to continue working and did continue working. Marie is asking me about the short report by Culper Research. Marie, this report by Culper is based on findings that were almost 3 years old. And if you go to the Tecnoglass website, you will get a complete understanding of how Culper is using a very old report to smear the company in the current time frame and perhaps try to manipulate the stock price. I would at least give Tecnoglass the courtesy of reading their retort to this report by these notorious short sellers.
Good stuff. Okay, let's keep pressing on. This is something we're working on to kick off next month. We're going to begin a discussion of the book written by David L. Babson. Again, to remind you, that was the first book reviewed in Better Investing magazine back in 1960. And we're going to use that as a launch pad to talk about other growth-related, growth strategy legends, basically. We're going to start in September and continue it every quarter, and we'll just see where it takes us. So that's coming next month. And after listening to Kevin Gologli and Ken talk about this book the other night in Atlanta, I should have recorded it, folks. It was an awesome discussion. Can't wait to see where this goes. All right. Here we go, Matt.
Oh, I thought I was number 3. All right. We'll do it. So
You're here.
I had so much fun. I thought I would bring it back again. This is VITL Farms. We can go ahead to the next slide. I do want to give just a little background. I know the roundtable audience is a loyal audience. Can you say that as a regular audience? But for anyone who wasn't here in July, because it's summer, VITL Farms is actually it's incorporated as a public benefit company. And its benefits are outlined. So they by their articles of incorporation have not just profit as a motive, but also several things, including the living conditions of their animals, the sustainable land management, and support of family farms. So they produce their first product and primary product is eggs. Their eggs are all pasture raised. You can see the pasture belt there is, and we'll get in a little bit more. That's where they do business. They engage for supply entirely with family farms, not corporate farms, in contrast with most of the egg industry today, and sell at a premium to many, if not all, large retailers, as well as a number of restaurants. So including not just Whole Foods, who was their first corporate customer, but also Kroger, Walmart, and a number of major regional chains like Publix and HEB, if you're in Texas. Next slide. So this was the SSG as I left it in July, looking to slow down in growth from historical growth of 30%. And there are a few years cut out. There was some jaggedness in their earnings, although revenue was quite steady, down to 18%. This company is lightly covered. It was 1 week before last roundtable that Value Line actually promoted them to the standard edition. So I had a Value Line number for 2029. Morningstar does not cover them. You can see there's no analyst consensus estimate there. So the other 2 dots in the revenue line are corporate guidance. And so being that I might have turned the corner a little bit, but I was quite well anchored to the few data points I had because this was a new company for me in projecting their possible growth. We can see the potential growth in return as of last month on the right-hand side. Next slide. So what happened? On one hand, I can say thanks, Mr. Market, for realizing my great presentation and giving me a 40% return in a month. I did buy some actually the day after I made the presentation, and I've actually bought a little this morning too. But I might also have my Gen X attitude on and say thanks a lot, Mr. Market, for not giving me another month before I realized how much I like this company to really load up on it. Next slide. So let's talk just a little detour into the greater industry to give us some context about the company, and then we'll get into its growth. So this is the major competition. This is Cal-Maine Foods, and despite that name, it's based in Louisiana. If you are in a dark blue section, you'll know Cal-Maine as Eggland's Best. They are a franchisee of Eggland's Best, so they don't have it across the country. They also are branded under Land O'Lakes, as well as a number of grocery store house brands. But the important thing is, as an exemplar of the industrial egg model in the U.S., you can see they have 49 locations that they produce shell eggs for. These are mature chickens laying eggs, and they house 51.8 million laying chickens, so just over 1 million per location. So we'll put that aside and carry on. What I really went into Cal-Maine to do is to find this chart. I didn't know it was this chart, but it was information I wanted. This is a little dense, so hang on with me. So this is a chart. The blue line on top is the overall estimated laying flock of the U.S. And the shaded areas, you might be used to some of these line graphs and shaded areas denoting recessions in an economic sense, but these denote where it says HPAI, that's avian influenza or bird flu. So the bird flu outbreak that you might remember in the mid-teens, COVID that was there indirectly impacting because the humans weren't available to care for a growing flock. And then what has been an ongoing struggle with avian influenza since the third quarter of 2022. This chart does commit one charting sin. So the layer flock is the y-axis on the right, and notice it doesn't start at 0. So that looks like a plummeting number, but it's really from about 340 to 330. So 10–12% of the flock has been impacted. Still a significant number of birds, tens of millions of birds, but we might cry foul on them for having a graph like that. Sorry, I had to do one. So, wait.
Go back.
One more point. So the other lines are the spot price of different types of eggs. The sort of taupe line, the dark brown line, is believe it or not, there's an egg exchange. There's an egg index. This is the Southeast Umerberry large size egg index. Shows versus the price on the left that per dozen, the price is nearing $7. What Cal-Maine gets for their mix of eggs is something about $5. The interesting part is that magenta line. The magenta line is their specialty eggs. This is not just pasture raised, but could be as little as cage free, which is sort of the first step out from traditional egg laying to pasture raised to free range. That line is a lot more steady. In normal conditions, it's above the standard line, but those are, and as I've noted, those are generally contracted. This is Cal-Maine's comments, in long-term contracts with customers as opposed to spot buy prices. And so even though their eggs are inflated, it has not happened to the type of eggs that VITL Farms competes with them on. One false thing you might take away from this is you should really run to your grocery store and buy all the fancy eggs because they'll be cheaper than the other eggs. That's not true. The grocery stores set the prices, and they have continued the price signaling of having these fancy eggs be more expensive than the other eggs. We'll get into, I don't believe they're evil for doing that. I believe that they're managing the spike in costs and spreading that over a number of things. But what I like about this for the long-term growth of VITL Farms is, unlike the traditional egg market, we are not really in a bubble that might burst and really impact the profitability of Vital Farms. They're on that magenta line. Now we can move. The other part of the industry I want to introduce you to is MOBA. MOBA is a Netherlands company, and so I don't think it's too much to say that this is sort of the ASML of eggs. They make large equipment that washes, grades, and sorts eggs, and in the words in the kind of orangish in the middle, they process 70% of all eggs produced worldwide. I don't know if they're counting Ken's neighbors that sell it on the roadside as part of that, but it's a lot of eggs. And also of note, their U.S. headquarters is in Wixom, Michigan.
Whoa.
So this is my, as I go and do my own estimate for the growth of Vital Farms, I'm going to use these machines, which are significant capital items, as my shortcut for tracking the scaling of their business. All right, so let's go to growth. Next slide. So this is a zoom in of the pasture belt, if you remember from their first slide. All the dots, of course, there aren't 500 dots, but call them areas where the 500 family farms are scattered across. And their current egg production facility, which they call Egg Central Station, was opened in 2017 in Springfield, Missouri. Obviously, very close to that large cluster, both in Missouri and in Northeast Arkansas. They got their first MOBA machine in 2017. They were quite happy to put another one in 2022, which the company communicated would add $300 million in revenue capacity. And there's another one coming in, and understand right now they're looking to be over $600 million in revenue total this year. But in the fourth quarter of this year, they will have a third line in Springfield, Missouri. So you can add that up. I don't put it for the first one, but roughly $900 million. Give me a click. The big news that's coming in is Seymour, Indiana is going to be a second Egg Central Station. The initial plan was to have 2 MOBA lines put in 2 different phases, and this year the company announced that it was pulling ahead all of the development, or the full plan development in Seymour, into Q1 of 2027. There are other factors in here, namely cold storage will be on site, which allows the MOBAs to produce or to process 450 million each, as opposed to 300 million. So one more click. So this gives us $1.8 billion in egg capacity, egg revenue capacity. And note that this is, for a company growing as fast as they are, and we'll see how they are, this is paid entirely out of cash on hand and cash flow. This company is growing 30% a year. It's not producing software. It's having to move these things around, and somehow they have cash growing out their ears. Now, 2 other points, and I made these at the very end of last month. Note how many family farms there are and compare that to Cal, Maine, right? With 50 sites and 50 million birds, I'll say Vital Farms has about 6 million. So it's about 1% the density of a site that is in Cal, Maine, and this is a natural defense against a spread of an epidemic virus. They did have one outbreak of bird flu in one of their sites that was 0.005% of their total flock. So this is not just waving the green flag or being good global citizens. This is actually a very smart business organization or business strategy in counter to the industrial farming standard of the U.S. Next slide.
Cool. Let's go ahead and put Ken's neighbors on there up here.
They could sign up. So now this is a representation of the change in growth that I have from last month to this month. This is not a semi-log graph like the SSG, and we'll see why in the next slide why I do it. But I've charted out a couple things. The dark green line is that capacity growth that I mentioned, the installations of the new MOBA lines, and we can see historically
Matt, excuse me, Mark, could you point to the dark green, because if other people are having trouble differentiating the colors I am, there's the dark green line. Okay, Matt.
No, thank you for that. Yes, the top line. the top jagged line. So you can see that they've been putting in growth, and their production capacity has really skirted the ends of that growth, right? They need more capacity constantly, and they're not scheduling a lot of slack in that capacity as they grow. The orange line, which starts back in 2017, is the solid orange line is the historic revenue straight out of the SSG, and the dotted orange line is where I had projected in July for them to grow. That is anchored by 2 points. There's a company target in 2027 of $1 billion in revenue, and then the value line projection, which I think is 1.25, call it that. So I was reluctant to really go higher than that because it was very new to me. The darker dashed line above that is where I'm thinking that we go in August. There are a number of reasons for that. The company actually has increased its 2025 revenue projection from $740 to $770 million, and is, again, with a growth rate of 30%. If they were only going to grow to $1 billion by 2027, their growth rate would actually slow to 13%, half. There doesn't seem to be any reason for that to go on. And then as well, it's the acceleration of Seymour. So that would be, if it followed prior practice, would be in 2 steps, probably look very similar to that with 1 machine and a second machine. The fact that they're pulling ahead 2 machines makes me believe that they're actually going to grow again into that capacity. I'll also make a small note. There's a small line at the bottom of butter revenue. I'm using the total company revenue versus egg capacity. There's a little bit of fudge in that. Butter is its second business line, but it's quite small now, so I haven't bothered projecting that separately or taking it out. I'm rounding it down, basically. Okay, so that is production capacity, but you need to make sure you have the chickens too. So again, this is another sinning chart with doesn't even have a y-axis. So they're protecting the secret, but they went from Q1 of 2020. They had 1.1 million hens. That's the red circle, who produced 13.1 million eggs. This past quarter, they produced 36.4 million eggs, almost 3 times. And the reason why the red line goes further is that it takes about 5 quarters from the time that a farm is signed to the time that their hens are producing eggs for the company. So they have a contracted volume of 9 million hens by this time next year, let's say, and expect the egg laying to follow along with that. There's the note there to the right of that 9 million. It says they will need 11 million to hit that $1 billion target in 2027. Now I ask you, thinking about the prior chart, there is a point, particularly for last month's projection, where growth rate is declining, right? The line is turning to the right. If you look at how they're bringing hens onto the company, is this growth rate A, declining, B, staying the same, or C, accelerating? To me, and again, without numbers, I read that as accelerating growth, although they've been very cagey about saying anything about that. Maybe there's another one, I don't know. And of course, these aren't just growing sites because
I'm taking notes, Matt, okay?
It's not just the hens, but it is family farms. They have a certain size that they would max out on, so they need more farmers. That's the point on the right. So they have, again, no access, but you can see the farms that they need to sign up for to get to that $9 million amount. They have a large pipeline of farmers interested in going on. And again, back to the other chart, there's a significant density of farmers around the Springfield, Missouri processing plant. They're much fewer in Kentucky, Ohio, Indiana. When the Indiana plant gets on, plenty of expectation for the density to grow there as well. So this should not be, it will certainly be something they have to work on. I don't expect this will be a constraint separate from their processing capability. Next page. So we conquer the world with eggs. What do we do next? Because we're thinking long-term in terms of growth. Every other company slide I've showed you so far, actually elsewhere in the presentation, all is from Q1 or Q2 of 2025. This slide, talking about things beyond eggs where they can go, dates back to 2021, shortly after their IPO. So this is a company that from the beginning has seen that its model of engaging family farms into premium priced products that are healthier for people, healthier for animals, better for the world, had always had a vision to go into other product lines as well. And as the eggs have generated significant cash flow that the company has not needed to take on debt to make this rapid investment, they can fund into other categories as well. So that's the growth section. Next one. There was the one and it might turn some people off. There was an audit comment early in the year. And in July, I had already foreshadowed that there was a system change that would address this. So that was to be addressed by the end of the year. There was some further detail in the Q2 earnings call, which happened in between my presentations, that talks specifically about an ERP changeover. Well, they call it digital transformation and remediation. So I did a little digging with getting some scuttlebutt. My AI helpers got half the answer. So the company is moving to Microsoft Dynamics 365. They were hiring a number of developers and support people last fall for this project. It took a little extra gumshoe work, extra manual work to find out that I believe they're moving from Oracle NetSuite, which I know they were running in 2018 and it didn't say anything in between there. So maybe bad news from Oracle. You know, the other part of this is the timing. They said this would happen in early fall. As a former IT person, I will tell you, if someone told me I had to move an ERP system, which is kind of like open heart surgery on a company, in early fall, I would say that's either going to happen this coming weekend or Columbus Day weekend, some 3-day weekend where there is planned lower activity or a bit of a longer weekend to go through. We all know, I'm sure many of you have, I know all of you Lamb Weston shareholders have dealt with the aftermath of a problematic ERP migration. So this is a near-term risk. Perhaps it will bring a price opportunity if it comes through, but I hope it goes well. Just FYI, and it should be resolved one way or the other. It should be out in the public certainly by the time the Q3 earnings call goes through. Okay. All right, so to the updated SSG. So I have increased my forecast from an 18% growth to 23.5% sales growth and a 25.9% earnings per share growth. This is above the guidance lines, and actually all judgments have stayed the same from last month. So I've only changed the growth rates that I have on there. So you can see it's well above the guidance, but I'm now anchoring more toward the capacity growth in the company's history of utilizing that capacity versus my sandbagging corporate communications guys who have updated their annual targets but not their long-term target, and Value Line, who's just recently brought them into standard edition. Next page. These are entirely the same, except that I've updated section 3 for the current price as of Friday. I think that is. It's a little bit more than that. We can see the current what was near the 52-week low last month is now certainly not just a 52-week high, but a recent total high of a PE of 44. Again, I've not changed my judgment, so we get to section 4 that's on there, but understand that is a bit of a drag on return now. Next page. So we get to the point, still looking at an average high PE of 35.3 and a average low PE of 14.5 with a low price of 16.20. I've not moved that at all. Just because we went up 40% doesn't mean we can't go down as well. So that's what I was comfortable with before I held myself to it. We'll talk about the yellow over on the right, but I want to do one more click through. So why would I be presenting to you a hold at 2.5 to 1? Give me one more click, Mark. I'm going to zoom in on the results study. So I'll have much more to say about this at Bink, but in my mind, and for the type of investor I am, a little more bold than average. This actually doesn't require you to be too bold. If I have a par of 13.5% and a potential return of 22% with a dynamic company that's under the radar so much it doesn't even have an analyst consensus estimate yet, I can manage. My stomach can manage a little volatility. If we compare it down to Manifest, you see Manifest, and this is up to date too, is a par of 10.4%. But Prove of 12.6% is right around that neighborhood too. So I'm comfortable being a little more aggressive with this, seeing that I'm backed up with Prove, even as the PE has to sort a few things out. One more click. And just in case you think I'm being really aggressive, what's popped up on the left now is data from Manifest from the Equity Analysis Guide, or EAGLE. So Manifest actually has a higher 5-year sales forecast than I do, a slightly higher EPS forecast than I do, a fairly low average PE ratio. So I'm actually not that aggressive. We're talking around what the PE could be, but even the data that feeds into Manifest agrees with me that that Value Line is being way too conservative, and the company is being very conservative in its long-term guidance as well. So that is, again, Vital Farms.
I'm speechless. Awesome. And there's clearly an increase in demand for eggs as a nutritional thing. You know, that kind of took a hit a few years ago, but now all the nutritionists are back on the, dare I say, chicken bandwagon, Ken?
Yeah, it's not like other protein prices have plummeted.
Yeah, exactly. All right. Wow, tough act to follow, Ken. I'm reeling here. All right. My grandson would like to thank all of you who voted for Brown and Brown last month. He did insert the cheetah slide, and he said it would put me over the top, so he wants to express his thank yous. And following in that moment, we actually discovered a slide from his brother, his slightly older brother from a few years ago. I had posted this on Facebook, and it's very profound. I asked my 3-year-old grandson if he ever pondered the meaning of life, and his response, as you can see it right there, pretty profound response, huh? And again, it's the type of thing, I don't know if I can do anything to protect you from chickens running around in the yard, but it's pretty good advice the next time you go to the zoo. It might actually save you. So Ken is just sitting there. I mean, you're dealing with sand and glass. We are bringing the animal kingdom to this situation here. So Nolan would like to, bring the African lion into play here, and there you have it. All right. Ken and I did spend a weekend in Atlanta, and this was the panel from the panel session from the Atlanta Investor Fair. Again, any of you who are in the crowd tonight here, we greatly appreciated the hospitality and a wonderful weekend in Atlanta. Part of my session was to sit on the panel and pick a stock, so I was leaning on the Sweet 16 that we put together roughly monthly, but literally going down a list of companies. In the Manifest Forum, we actually take you through the searches and the companies that we identify for potential stock studies and audits. And you can see Brown and Brown is there from last month. Again, Logie, thanks you for that. But some companies that have been on our radar screen quite a bit, radar screens of the community also, Novo, Gartner, Nice, the Fortinet we're going to talk about in greater detail, as that is my selection. But there are some very interesting companies here. Radiographic company Lantheus. Aligned is an interesting company with some of the deferred procedures that have been deferred during the pandemic, and they're just now catching up. And some of these companies here could be some pretty decent studies too. Tom Lee, a frequent guest on CNBC, he tends to think like us, and he's a very thematic investor, and he runs this exchange traded fund called Granny Shots. I want to have a quick look at a couple of these out here on the end. And I don't know if we even cover Willis Towers Watson yet, but if we don't, we will. And we want to try to figure out what Tom Lee sees. For part of this search for companies, we've leaned pretty heavily on what we call our cash flow aristocrats. We'll talk about that. You can actually look at all of them using that link on the lower right. So we're looking for companies that have very strong cash flow characteristics. As you can see here, Fortinet is quoted to have majestic aristocratic cash flow. So I don't know how either Ken or Matt are going to be able to keep up with that. But here you go. Fortinet down here, the things that really captures my attention, good growth, even if that drops off a little bit with an audit to the mid-teens or 13, 14, 15, it's still going to be a very strong number. And you're seeing basically a collection of companies that could be worthy of study. You can see Brown & Brown and Novo in here in the 13 range with decent returns. Looking down the page, I'm not sure I've forgiven FleetCor yet. And Texas Roadhouse has been under some pressure, but has fairly decent underlying fundamentals. So again, just a list of companies that we might take a closer look at as we delve for opportunities. Well, here's a look at that cash flow aristocrat characteristic for Fortinet. If you're not familiar with the company, they're not a company you're going to run into very often, but they touch you every single day. The reason I know that is because they basically provide internet security for 800,000 customers. That would be websites, software manufacturers, anybody who works at all with anything electronic, 800,000 customers across the world. So these guys have a very solid reputation, a huge track record of reliability, very, very respected. Your servers at Better Investing are protected by their product, the FortiGate product. So, and I'm sure Matt is pretty familiar with them from his career in similar areas.
Yep.
So again, they seem to do a pretty good job, unless Matt's going to correct me in his attempt to win by chicken farming.
We compete, but it's a friendly competition. I own Tecnoglass. I've been tempted by Fortinet, and yes, Fortinet have some career experience with. So I can't say there's a bad pick here. It's just a very close race, but the chicken will win.
Okay. Now, the recent report from July, and look forward to the next one, basically characterized this as a pretty solid company for the long term. Might want to wait for a price pullback, and that's according to Charles Moran back in July 11th. And again, if you want more information on these cash flow aristocrats, just simply Google or doc in on, just search that term, and you'll actually be taken to a report which describes it. What you see here is Fortinet basically having better cash flow year after year after year for 9 straight years, and then I think they're off by a nickel right here, and that is a projected number for 2025 that could still come true. I'm actually pulling for them to pull off a 10th straight year of increasing cash flow, but again, that's a pretty solid picture for the company. I do think that Value Line probably needs to scratch their head a little harder over here. I don't think that's a pretty good outlook. If that's right, I'm wrong. Okay. So here's a look at the company. The price has dropped from the $110 to $120 range down to $80. And that was just simply on them expressing some suppressed forward-looking guidance in the most recent dog and pony show that they put on. But you can see that the quality has been very consistent over the years. The par is in that mid-range for what we're after. We're not looking to be completely sexy here. This is a solid pick is what we're going for. And the return checks in at 10-ish, nothing wrong with that. And pretty much checks across the board. You can see that your community pretty much agrees that it should be somewhere in that 13 give or take range by the histogram from the sentiment index. So you can see a pretty decent picture for this company. And here's just some of the main numbers that you want to think about. Even if you go down as low as 13.3 for the sales growth, the PE of 31 would be fairly low compared to their historical levels. So again, these numbers have a little bit of conservatism built into them. This one's key. They have been hammered. Stock price is down. The relative strength index is down at 29.8. That's suggesting that the company could be temporarily and potentially oversold. The earnings growth forecast is in the mid to high teens, nothing wrong with that. And again, when these two are lined up pretty close together, within striking distance of each other, you've got a fairly feasible situation. So Value Line, with the price drop, has actually dropped into the 15% projected return area. And you can see that the analyst consensus, and unlike Matt's company, there's a whole flock of analysts following this company, and they believe that it's as much as 35% underpriced. So again, big drop right here. Big drop, the same one that Charles told us to sit and wait for. And it happened. So it has happened. And you can see that the company had, this is the longer term look going back over 10 years. These are monthly price bars. You can see that it does do this from time to time. So it's not unprecedented. So here's a look at the guide. Again, a fairly credible situation. I do think that thanks to the forward-looking guidance that you see some of the sales and earnings numbers by the flock of analysts may be dipping down a little bit, but it's still a pretty strong picture. And okay, they're not going to grow at 20%, but what's wrong with 13.5 and 13? And the profitability of the company, they have very high profit margins, and they continue to protect and maintain. And you can see from this trend here, pretty strong looking picture when it comes to the profitability of the company. So they don't seem to be under any particular intense pressure competitively. So you're looking at a situation where with 45, which by the way, they've been trucking around for an average PE, not the high PE, average PE in the 40 to 60 range. So 45 for the high, 25 for the low. You're looking at a price range that's pretty consistent with what Value Line has to say. That drop in stock price has given us what appears to be a potential buying opportunity. Again, we're not looking to set the world on fire, but again, I go back a couple of years, was it a couple of years ago, Ken, that you presented this company, and I'm recycling your idea. And I believe that you presented it at about a 20% higher stock price than it is today. So if you liked it at 100 for Ken Kavula, it's now closer to 80. And it certainly hasn't shown any great signs of weakness. So I still think it's a pretty good situation. So I'm going to say let's go ahead and throw another $1,000 on the fire for Fortinet and internet security and a cash flow aristocrat.
Okay, Matt, we have somebody in the audience suggesting that I run a poultry. Okay, so I will.
In the spirit of things.
I will be getting this poll ready to go here.
I did. There was another person that that said she had bought my stock after the presentation in July, and I wished her good luck.
Well, that's our friend Joan, and she bought it at the opportune time. So here we go. The poll's going on. We are asking you to vote. We'd love to have 85, 90, 95% of you voting. We're moving towards 50 there. We just hit 50%. Doesn't cost you anything, so just give us a vote, folks, okay? Somebody voted for the period in the number 5 position there.
Well, that's powerful.
You can't take your vote back, but if you voted for the period, I don't know what you're thinking here, folks, okay? All right. So we're up to 78% voting here, 79. Let's get another half dozen of you voting. Try to get it up to 85, 90% if we can. 82, 83. Keep it moving here, folks. Come on. That's 1 minute we've had the poll open. I'm going to give it another 10 seconds and then close it. There's that 85%. That's wonderful. And I'm closing it at 86% voting. And we're going to reveal the results. And Mark, 2 months in a row. What do you think of that? Okay.
Well, I'll tell you, when you actually leverage your grandchildren into the situation.
Yeah, I know. You know,
not something I'm
necessarily. Any more animals left?
Okay. You know the answer to that.
Yeah, I know already. Okay, so about half of you felt Fortinet was the best choice. About a third of you felt Tecnoglass was the best choice, and about a quarter of you felt VITL Farms was the best choice. 1% didn't like any of them, and 1% wanted the period. So we're ready to go here. I'm going to hide the results, and Mark, you can continue the slides.
Okay, is my screen back displaying?
Yes, it is.
All right, and for those of you that aren't aware of this, we do archive all the presentations on YouTube. You can search for it under Manifest Investing channel. Just search for Roundtable. You can see last month's session if you want to warm up to some more chicken salad. You can go ahead and grab that one. And we do archive all of the bull sessions. I will say that the last 3 bull sessions have been pretty popular. You can see the views are up a little bit. We've been talking about some early stage investing over the last few sessions, and the last 3, including a moment with Matthew McConaughey, have been pretty popular. But again, if you want to check in on those, you can do that at your leisure. Here's the original presentation back a little while ago, 2 months ago, our original work on the cash flow aristocrats. And Ken, why don't you go ahead and brief everybody about where we're heading to?
Well, the Heart of Illinois runs a breakfast club on Wednesdays at 9 a.m. Eastern Time, 8 a.m. Central Time, and they're always looking for people to come and join them in their sessions. They're quite folksy and a lot of fun, so give it a try if you're up at that time of the morning on Wednesdays. In our September roundtable, remember we're going to have a program at 6 o'clock, a special discussion on growth investing, and we'll be adding these fireside chats to our programming once a quarter to see how they work out. Mark and I will be in Northeast Ohio in Cleveland, just in the suburbs of East Cleveland, on September 27th, doing a 2 Guys Talk Successful Investing. On the Saturday after Labor Day, and it's not on the calendar, I'll be in Greensboro, North Carolina. If any of you are near Greensboro, North Carolina, come join the chapter there. I'll be talking for half a day on just some general all-around interesting topics. The October Roundtable is the regular last Tuesday date. Our best small companies, we'll be releasing them on November 1st, the day after Halloween. That's a Saturday. And I think we're going to be doing that at 10 o'clock in the morning, but more information is coming out. And then we've put together dates for December, January for the roundtable. Don't forget that the NAICBI National Convention is tentatively scheduled for Chicago at the end of April 23rd through 26th. I will remark that that September roundtable is not the last Tuesday of the month. If you've marked your calendar on the last Tuesday for September, please remark it. That will be on September 23rd, not the last Tuesday. There's a conflict going on, and so we're going to move it to September 23rd. And of course, these dates are always subject to change, so you can watch us under the manifestinvesting.com. The events are all listed there for you to take a look at, and they're also on the Mid-Michigan website, which is part of the Better Investing website at betterinvesting.org. Thank you so much for coming today. It was a wonderful August audience. This was one of the larger August audiences that we've had over our 16-year history. So we're saying thank you for showing up, and have a wonderful Labor Day weekend. It's going to be in the 50s and 60s here, just my kind of weather. And with that, Matt, thank you for a very entertaining presentation. And Mark, as usual, thank you for all you do for our chapter and for our community. And with that, I'm going to say good night to everybody. And again, have a wonderful Labor Day weekend. Bye-bye, everyone.
All right. Scramble those eggs.
Good night, everybody.